See how it goes today. Hope this works. We're running a little late because I forgot my microphone. Well, good morning. It's Greg Farrell. Money Matters with Greg is the show here at WVLP 103.1 FM. And we're excited to bring you the show today here in October. Happy fall to everyone. I hope everyone's having a fantastic day. It is a beautiful day here in the wonderful world of Valparaiso, Indiana, which is where the show is located. We are located here in Valparaiso, Indiana, and inside the Midwestern charm of a great town, and ultimately am financial advisor to a number of clients all the way throughout the nation. And we bring much of what this show is all about is about helping you save money and finding some ways to be able to make some money throughout your life, increase your wealth, grow and create your wealth, protect and preserve your wealth, distribute your wealth during life, and distribute your wealth after death. So that's basically the four quadrants of wealth that we talk about here on this show. And the show is all about money, and we typically talk about the market. I like to be able to talk about the stock market early on. And then I'm going to bring up something here in the second part of the show about, if you remember the retired baseball player now, Bobby Bonilla. I'm sure you know about him as a Mets fan. If you are a Mets fan or even a baseball fan, I want to talk about what his contract is and how he's still getting paid to this day as a retired 55-year-old baseball player. But when I talk about the market, we always like to be able to bring up what's going on in the market. We've ended the quarter of the third quarter here in the year. October 1st was the end of the quarter. And with the end of fall, or the end of summer officially, and now the beginning of fall, I want to be able to talk about the market. Just real quick, you can find us on iTunes. That's where our podcasts are under Money Matters with Greg. For any previous episodes, we have over 100 and some episodes there. Really enjoying that. And then we are now putting up videos from the show on YouTube. You can find it on the Farrell Wealth YouTube channel. It's everything's basically under Farrell Wealth, so FARRALLWEALTH. You can find on our YouTube channel, and then also follow us on Twitter at Farrell Wealth, Facebook as well. Ask us any questions. Love to be able to hear from you as much as possible. And just get some ideas for the show. You can also email me at any time, greg@farrellwealth.com. Would love to hear from you. So, again, hoping to bring some sort of value to you and your family here today, and just sort of giving you the updates as far as the market, where we're headed, where we've been, and where we're headed. I always like to be able to do the first 5 or 10 minutes as far as what's going on, what we're seeing. So, overall, as far as the overall stock market, investors really endured a huge flurry of trade headlines and emerging market turmoil in the third quarter. It didn't really slow U.S. stocks, though. The S&P 500 rose 7.2% during what has historically been a very volatile quarter of the year. That's 7.7%, including dividends. So it's really been the biggest quarterly gain since the fourth quarter of 2013. Its best performance in the third quarter since 2010, and the 11th gain in the past 12 quarters. It's really notable that the S&P 500 did not close up or down 1% in any day during the quarter, which is amazing. Only the second time in history that feat has ever been accomplished during the usually volatile third quarter, which was 1963, the other time it happened. But really want to recap the third quarter, the highlight of some of the key factors in the market, and the overall, basically talk about what's going on in the fourth quarter. So a little bit of recap. Stock market's third quarter performance was impressive, given you talk about the tariffs that were going on and all the different trade tensions. And those weren't the only challenges. They had the fiscal stresses in Turkey, feared sparks of contagion in the emerging markets, which entered a bear market in August, by the way. The Federal Reserve, which means it was down over 20%. The Federal Reserve raised interest rates for the 8th time this cycle. last week and is on track to hike again in December. Long-term interest rates rose during the quarter, but the yield curve stayed flat in what some believe may be a sign of near-term economic weakness. And this upcoming, of course, the upcoming midterm elections introduce a ton of policy risk. So you start throwing all those things in, you'd think the market would be reacting a different way. And add to all of that the fact that the third quarter has historically been the worst quarter for the stock markets. Stocks sailed right through all these headwinds and extended the longest bull market ever. Um, Strong performance of the U.S. economy was clearly a primary driver of the market strength. Gross domestic product (GDP) grew at a really strong, though not likely sustainable, 4.2%, and this is an annualized pace in the second quarter. We're continued with continued support from fiscal stimulus. Expectations for a solid 3% growth in the current third quarter is based on Bloomberg's consensus forecast, but we'll see. We'll see how that turns out. Manufacturing activity remains robust. The Institute for Supply Management's Purchasing Managers Index is reaching a 14-year high in August. Again, we've been talking about the economy and how strong we've been seeing it, and this is just a continued follow-up. It's basically, this is what we're seeing, and this is ultimately the facts that are coming in. Business confidence is strong. This small business confidence in August reached its highest level since 1973, according to the National Federation of Independent Business. And the Business Roundtable and Chief Executive magazine surveys of the U.S. CEO confidence are also elevated. Consumers really remain upbeat as well, with the Conference Board's consumer confidence measure at an 18-year high. Job growth remains steady and income growth accelerating, but still not enough to spook the Fed. So in addition to this solid performance, U.S. economy, corporate America delivered one of its strongest quarters of earnings growth in decades, supported by the tax reform. More stellar earnings growth likely over 20% based on Thomson Reuters consensus estimates is expected in the third quarter. And this would be the third consecutive quarter of earnings growth over 20%. Look, the overwhelming majority of recent data reflects this solid backdrop we've been talking about. It's not all good news. The housing, auto market have both cooled. Tariffs have started to curb some capital investment, and growth in Europe is certainly slowing. So these are things we're watching, we're trying to follow as far as the market goes. But in terms of market cap and the market leadership, that's what we always preach here is who's going to lead this market higher. And it's really a matter of just finding out who that is, what industry or what asset class is that going to be. The globally focused large caps really led during this last quarter, which is encouraging because these ongoing trade disputes with our largest trading partners is really what's been in the news. The U.S. dollar advance really paused which helped the U.S. multinationals relative to smaller, more U.S. focused companies. So these large cap stocks in healthcare and industrials, technology sectors all performed pretty well. So it's something to keep an eye on. Now, the dollar has definitely made an effect here in October already, and we've had a couple down days in the market just recently. But this is basically I'm just going over the follow-up for the entire quarter. So what can we look at as far as any sort of tailwind? Is there a seasonal tailwind? Is there something we want to see here going into the fourth quarter? And historically, the third quarter has really not seen it has seen the worst average performance, the S&P, among all four quarters. Stocks far exceeded their historical seasonal pattern last quarter and up 10% year to date based on total return of the S&P 500 index, which really begs the question, where were gains from the seasonally strong fourth quarter potentially pulled forward into this third quarter? And it's certainly possible that the historical fourth quarter tailwind could be muted, mainly because political uncertainty is certainly going to be weighing on investor sentiment as the midterms approach. A strong performance from the Democrats may lead to some rollback of the Republican tax cuts next year. However, a late year trade agreement with China, which is still our base case, really, which we could see, it could enable this strong seasonal pattern to hold. A trade agreement between the U.S. and Canada was reached over the weekend in a positive development of the trade front. This is last weekend, and has the fourth quarter of really off to a great start as far as that goes. That's really good. Investors may also like the political clarity that an election result would bring, regardless of the results. I've always said this, even though there's stalemate and even though there's gridlock, that's certain that that's going to happen. The market's okay with that. The market likes to, they like certainty. So if it's certain nothing's going to get done, the market's fine with it. So it's always kind of an interesting thought, but that's just is what it is as far as the market cares about. I want to do a quick thought on the bond market. Bond market has had just a troubling year. We talked about this at the beginning of the year, and really we're trying to warn you that as interest rates rise, it's not a matter of whether you're going to lose money in bonds, just a matter of how much. So the third quarter really has been challenging again for the bond market. The Bloomberg Barclays Aggregate Bond Index was flat over 3 months. Now year to date that index is down 1.6%, and this really sets up potentially one of the weakest years over the really for the going back to the bond benchmark down, let's see, 1978. It's one of the weakest years since then. And during the quarter of the year on the 10-year, it rose from 2.85 to 3.06. And this was pushed higher by solidifying that Fed rate hike expectations and the modest pickup in inflation. So you really have to suggest that for the suitable investors, you hold your bonds in your portfolio. This may provide some cushion in the event of any sort of market declines, of course. And if you're a conservative investor, this is this is where you look to be. Higher rates offered by the short and intermediate parts of the yield curve have really provided investors these potential opportunities to generate a reasonable amount of income with a relatively limited interest rate sensitivity. So you really have to continue to recommend mortgage-backed securities, investment-grade corporates, among high-quality fixed income options. So for appropriate investors seeking more potential income, you really have to suggest moderate allocations to bank loans or even high yield bonds, which carry relatively less interest rate sensitivity to than the core fixed bonds that are out there. So they tend to be a little bit more volatile due to the credit risk, but if that's what you're reaching out for, be careful. Obviously have a plan and make the plan in regards to your fixed income allocation, but that's basically, it's tough. You don't go into bonds to lose money in a year. So that's what's been happening. So I really want to make sure, just make sure you're careful. I did just come out with a new letter to all investors. I'm going to put it up on our website when I get it. When we get the chance, it's for basically October, talking about the third quarter, talking about strong stock gains, talking about October's really known for its volatility, and then also the election. So I'll put that up, and you can take a look at that to see what we're sending out to investors as well, and feel free to check it out. So the show's Money Manager Greg. I'm Greg Farrell, CEO and President of Farrell Wealth. It's a registered financial advising firm. That's a wealth management firm here in Valparaiso, Indiana, and we help people with their money. Help manage the money. We do 13 steps of different topics of things we see high net worth individuals and families have issues with and have things that they need taken care of. And these involve everything from investments to insurance to gifting strategies to titling of assets, stock options, employee compensation packages, 401ks, retirement plans, you name it. Some of those are some of the 13 things, and we kind of bring these things to you as an audience to talk about on the show Money Matters with Greg. So you can find many of these shows on iTunes and certainly listen to the podcast. And then we will be promoting these, putting these up on the YouTube channel, Feral Wealth YouTube channel, and looking forward to that. We are filming with a green screen and making things look pretty here, trying to, certainly prettier than I am. I have a face for radio, but we're happy to try to bring this to you guys and help you out. I wanted to bring up something here in the last 10 minutes of the show or so about that was on marketwatch.com. It's a story that is written by Stacy Rapicon, and I always like to be able to bring forward things that I'm reading and certainly what we're reading about the market. And it's basically about a retired baseball player's contract that is the perfect example of compounding. We talk about in this show compounding interest and compounding of money, and I just wanted to be able to bring up, it's very rare I get something that is a perfect example, let alone a perfect example in sports. As we all know, we're all fans here, really in the Chicago vicinity. We're big-time Chicago fans across the board with a number of different great teams that we have opportunities here. Our Bears were on a bye this week, so it was quiet, but we were able to watch the Blackhawks in an amazing game last night. That was tied at 6 and went into overtime. And unfortunately, we weren't able to pull through, but it was a great Toronto Maple Leafs Blackhawks game. It was tremendous. So I'd like to be able to talk a little bit about sports, but for the most part, we talk money on this show. So today I get to talk a little bit about both. Bobby Bonilla, if you remember him, is a New York Met, and he was very popular, obviously, with Pittsburgh, and then onward, got a big contract with the Mets, and really did not pan out as a player, or did not do very well in regards to his career. But while most people celebrate America's birthday in July, former baseball player Bobby Bonilla has his own day to enjoy, and that's July 1st. July 1st marks his annual payday. Now, how would that be? He's retired, right? Well, when he was a New York Met, so the New York Mets this last July sent him a check for $1.19 million as part of his deal that was set up 18 years ago. Now, how's that work? Well, in the year 2000, the Mets cut the once promising Bonilla from the team after years of disappointment. They terminated his contract early, and the ball club owed him $5.9 million for that season, even though he didn't even play a game. So they cut him. Bonilla and his agent, Dennis Gilbert, at the time, opted to hold off on collecting on that at that time, and instead agreed to spread the payments out over 24 years, starting in 2011. Now, so what was the interest rate? Well, the interest rate was pretty high. It was at 8% annual interest rate. So to date, the 55-year-old has collected more than $9.5 million from this deal. And when it's all said and done, the total payout would be $29.8 million. Now, that might sound like mathematical magic, but Bonilla's contract with the Mets is a brilliant example of power of compounding. And conversely, from the Mets' point of view, the drain of paying interest. So for those that need a refresher, let's just mention compounding is when the interest you earn on your money also earns interest, and so on and so on and so on and so on. So how does this matter to me? Well, and how does this matter to the audience, and why do I bring it to you? Well, you may not get offered these millions of dollars to leave your job, or a guaranteed return of 8% a year on anything, but you can still apply this savvy strategy to your own finances and enjoy a happy payday yourself. Now, like Bonilla, you can defer pocketing your cash by saving and investing it now, giving it more time to grow. And when you're young, it's obviously time is your best friend, and the magic of compounding is really an incredible thing. Now, plus, putting away money now helps you bank more flexibility for later. So one of the main reasons to start saving early is to give yourself options down the road, right? So start saving early, build a nest egg, and let the compounding sort of keep on doing its thing. And if you take this example and you start with $100 a month at the age of 25, stick with me on the math here, but if you start investing $100 a month at age 25, and you assume an 8% annual return, which is high, but let's just go run with it because the math works. You'd have $18,500 after a decade. So $100 a month, that's only $1,200 a year. Well, now how do you get 18,500? Well, it's the power of compounding. You compound the interest every single the earnings, and you keep on. You never touch it, and it just keeps on making more money. So now, if you stopped at that point, if you were after that decade, and you just let it ride, and you did nothing to it, you'd have more than $200,000 by the age of 65 without investing another penny. So that's a really good example of saying, all right, you know what? I'm 25 years old, and I can find $100 somewhere a month. If you think about it, it's only a few dollars a day, and we always talk about cutting out those small luxuries. Well, you know what? You don't necessarily have to cut out luxuries in your life. I'm not a fan of saying, I'm not going to go to Starbucks. If you enjoy that going to Starbucks every single day, well, then go to Starbucks every day. It's your life. Go for it. But if you need to carve out money from other things, well, then that's what you should be doing. You should be negotiating with your cable company. You should be negotiating with your wireless company, and trying to carve out that extra $100 or whatever it might be out of your budget to then put it away and continue to compound. So, some years are going to be good. You're going to get an 8% return or even better, and some years are going to be worse, and you're not going to necessarily get that. But for an annual return over 10 years at the age of 25, to have $18,500 by the time you're 35, and then suddenly $200,000 by the time you're 65, is what it's all about. So I really want to be able to just mention how Bobby Bonilla, what a smart thing that he and his agent did at the time to say, look, I don't need $5.9 million today. Maybe interest, maybe tax rates were at a certain time where he was going to take a huge hit. He was living in New York at the time, so obviously the New York tax rate must have been extremely high. But this is a really good planning uh, conversation about what you do, and if you do have a windfall, is there something that you can do to try to minimize those taxes or stretch them out over time or whatever it might be. Now, we're not accountants and we don't play one on TV. You certainly have your team for that, and I highly recommend you find a really good accountant. But these are things that are just really good examples that even though he didn't even play a game for the Mets, he got $5.9 million. And then that was stretched out over 24 years, starting in 2011. So, he got cut in 2000, and then obviously the Mets didn't even have to pay on it for 11 years. So they had a huge benefit in being able to push those salaries off, or all these payments off to go against the salary cap or maybe the luxury tax in regards to what that would be in the MLB and in the baseball league. But that was their choice. I mean, that's what they decided to do. They were the bank in essence in this situation, and they agreed to spread the payments out over 24 years, starting in 2011 with an 8% annual interest rate. So I'm sure that was all negotiated at the time. I'm sure the Mets said no. How about 5% interest rates or whatever it might be, and they probably asked for 10, and they agreed on 8. So something to that effect happened behind closed doors. But to date, the 55-year-old now has collected more than $9.5 million from the deal, and it's really an annuity or a pension in essence that he can get. He can, as long as he makes it to July 1st every single day, and just keeps on keeping on. All said and done, he's going to have a total payout of $29.8 million. I just thought it was fascinating. So, highly recommend you do the exact same thing. No reason why you can't be Bobby in this situation, and hopefully, put away some money. Use the magic of compounding, and use it as your best resource to be able to make sure that you can kind of plug along. So, just wanted to be able to bring that story to you here as we wind up the show, and just make sure that you are putting money away, and I highly recommend that you do. So there's Bobby Bonilla. Good for him. It's a kind of a cool story to be able to talk about. The show's Money Matters with Greg. I'm Greg Farrell, CEO of Farrell Wealth, CEO and president of Farrell Wealth, and it's a wealth management firm, a licensed financial advisor, registered advisor. And we talk money on this show, and would really appreciate anyone to contact us, contact me at greg@farrellwealth.com. Just send me an email if you have any questions or you have a topic that you might really like to be able to have us talk about, or have me talk about, or have a guest on the show that is an expert in the field. Please just reach out. Love to hear from you, and thanks again for listening. You can find us on YouTube with all of our all of the videos at Farrell Wealth on YouTube, the YouTube channel. You can find us on iTunes. Money Matters with Greg for that. Just search Money Matters with Greg. You'll get the podcast from previous days and previous shows. And Twitter at Farrell Wealth as well. Facebook at Farrell Wealth. So just find us, reach out to us if you've got some questions on money. Certainly, we'd be happy to help, and would love to be able to give you some advice down the line. So that's the show today. I want to wish everybody a happy fall, and look forward to one of the best months in the Midwest for sure, with all the leaves changing and the weather's changing, and it's just it's one of my favorite times of year. Football's alive and well, baseball's alive and well, hockey started. Here we go. So very excited to be a part of the show today. I want to thank Greg Kovach for being the engineer and running the board, and look forward to talking to you guys in a week. Have a very healthy and profitable week. We'll see you next week.
Greg Farrell is the president, CEO
Cool.
of Farrell Wealth.
See you guys.